Okay, hello there. It's Paul Green here from the business community, and I'm joined by Jamie Cochrane. Hi, Jamie.
Hi, Paul. Thanks for inviting me along.
No worries. So this is part of a regular business bulletin series that we're going to be doing, and it's in light of the current economic climate, and we're going to be trying to helping people out with regard to redundancy issues. If you're being made redundant, you have been made redundant, or you're an employer that's having to make people redundant, then there's a series of these events. But today I thought we'd look at what it's like for businesses who might be suffering right now and struggling along the way, as some sort of sectors are. So I've invited Jamie along today just to share some of his infinite knowledge with us, and just rearrange the screen. There he is. So I'll let him introduce himself in a minute, and then we've got a little PowerPoint to go through, and then hopefully at the end there'll be an opportunity for questions. If you are live, if you're watching it on the replay, then wherever you're watching this, you can always put questions in the comments, and I'll make sure Jamie's tagged in so he can respond to them. So do you want to introduce yourself, Jamie, and then once you've done that, we will launch into the presentation.
Yeah, thanks, Paul. Hi, everybody. My name's Jamie Cochrane. I'm an associate at PBC Business Recovery and Insolvency Limited. We're a firm of insolvency practitioners. We provide financial advice and solutions to both businesses and individuals that are struggling financially. We have offices in both Northampton and Bedford, but we have clients all over the country.
Okay, great. Well, I'll hand over the floor to you now, as it were. I'll take my ugly face off the screen so we can focus on you. And so, yeah, if you want to go ahead and just sort of run through some advice, and then we'll just sort of like move on to questions after that, Jamie.
Thanks very much, Paul. So today I'm just going to do a little presentation about your business is struggling and what should I be doing if that is the case. So we're just going to go through a few little things there about sort of the structure of your business and how that can impact on the options available to you. The actual formal definition of insolvency, how you can end up in problems, some of what I call the elephant traps, which are more commonly known as, or properly known probably as, antecedent transactions. These are sort of transactions that you can end up in and could potentially lead to personal liability on your behalf. A little bit about 2020 and how that's been a little bit different in the insolvency world this year, and then the final summary there about taking advice. And my mouse has now disappeared. Where's it gone? There it is. To go to the next slide, please, as they like to say, number 10 Downing Street, all the time. So the business structure, you could be either a limited company, which, as the name suggests, means limited liability for the shareholders. But you could potentially have signed personal guarantees as a director, which would mean that any creditor could ignore the liability of the company and pursue you as an individual. You may be a sole trader, in which case you as the individual running that business are completely liable for all the debts of that business. You could be a partnership. So this is where two or more people are in business together with a view to a profit. You might not actually realize you're in a partnership. You might just be two people that you think that actually we're just running a little business here, but actually that is a partnership. It could be a husband and wife team. Partners are jointly and severally liable for the debts of the partnership, as it says there. Look, I'm even anticipating my own slides here. Or you could be a limited liability partnership, which is like a cross between a partnership and the company. But as the name suggests, there is limited liability for the partners. Let's move on to the definition of what insolvency actually is. This is as defined by the Insolvency Act in 1986. A company is deemed unable to pay its debts if one of the following occur. The first is that a creditor who is owed more than £750, that limit has remained unchanged since 1986, has served a written demand, often known as a statutory demand, and that demand has remained unpaid for 3 weeks. The more general scenario is that the company is unable to pay its debts as they fall due. Debts are now becoming overdue and creditors are chasing for payment. Or that the value of the assets is less than its liabilities. Now, that last one would capture a lot of companies, and it tends to fall on the first two tests, really. For an individual, the tests are similar but slightly different. This time it's a creditor that's owed more than £5,000. That limit was changed recently, but the company one was left in the same position, or that you're unable to pay the debts as and when they fall due. If either of those tests is met, your duty reverts to protect the interests of creditors. This is really important when we come on to the elephant traps later, and especially for the companies, the directors, normally their duties are to the shareholders, but as soon as the company is insolvent, that duty switches to the creditors. So here are some typical scenarios of what can go wrong, what can lead someone to be in an insolvent situation. First is cash flow management. As the saying goes, cash is king. Have you prepared a cash flow forecast? Step one. Step two, if you have, what have you done with it? Are you constantly reviewing it, seeing where you are compared to it? Or have you just prepared it and then you've got no idea where it is? Are you allowing people to take generous credit control on you? Are you struggling to collect your debts that's due to you? You'd much rather that money to be in your business rather than sitting as outstanding. And as a follow-on from that, you could have suffered bad debts. We often see companies that come to us and say, I've got a perfectly viable business, but I've just suffered a bad debt. And that has been the one trigger that's led them into a problem. And then as well as the bad debt, it could even be, obviously, of course, as well, you've lost a customer. So your turnover is going to reduce going forwards, but you might be able to replace that. But you've still got to pay your creditors for the debts that you haven't been able to receive into yourselves. Tax compliance is a major issue. They deem themselves to be the involuntary creditor because they are the person that you don't have to keep paying in order to carry on trading. You need to pay the people that you get your supplies or raw materials in. But the tax man just sits there and you have to pay him because that's what the law says, but you don't need to actually pay him to carry on trading, in terms of no one's going to place you on stop, and it's not going to mean that you're not going to be able to make and sell some new stuff. You could lose trade. That could be, for example, if you take a company like Blockbuster. Blockbuster was a viable business, and then something has changed in its marketplace and it just didn't adapt. Or you could be over trading. Things could expand very, very rapidly, which might on the face of it sound like a really good thing, but it can mean that you are unable to obtain credit to pay for the supplies that you need to make those sales. And you end up being in a position where you can't meet sales, and then you have a loss of reputation and things end up going wrong from there. Last but not least, we've seen a rise of this recently where pressure on a business can lead to management having disputes, falling out with each other, believing that the business should be going in different directions. And the management then spend time arguing about what should be happening rather than actually focusing on the business and trading going forwards. These are what I call the elephant traps. And I will briefly explain each of them once I've had a drink. The first is a preference. This applies to both companies and individuals. A preference is where you are putting one creditor in a better position than any of the others. The insolvency practitioner who is challenging this must prove that you had a desire to put that creditor in a better position. But where that creditor is what's known as an associate, so connected, whether through marriage, other family relationships, and even companies of those family relationships, that desire is presumed, and you have to say that you didn't have the desire to pay your brother over and above it, the tax man, for example. That's going to be very hard to disprove. The next one is a transaction at undervalue. This is where assets have been gifted away or sold for significantly less than they're worth. So clearly, you're just trying to get assets out of the company, probably to yourself, and creditors aren't receiving the full value for that asset. Transaction defrauding creditors is similar. Again, an asset's been given away as a gift or significantly less. But this time there must be an intent to place an asset beyond the reach of a creditor or any person that may be looking to make a claim. There is no time period on this. So it could be, for example, you take a husband and wife. One of them is going to go and run a business. So they decide, for safety's purposes, one's going to incur all the risk and all the liabilities, and they're going to transfer the matrimonial home into the other one's name. The sole reason behind that was to put that asset beyond the reach of any creditor that might come claiming should the business fail. And that can go back up to 20 years in some cases. Wrongful trading is, this one applies to companies only. So this is where the directors ought to have known that there was no prospect of the company avoiding entering into insolvent liquidation or administration. And at the time they should have realised that. What did they do? Did they carry on recklessly incurring further liabilities? And it's that increase in the liabilities that a director can be held personally liable for. Fraudulent trading, that can be a single act. The commonly cited case here is of a company took out a £150,000 bank loan, withdrew £145,000 of that loan to the director's personal account, and then placed the company into liquidation. There was obviously no intention when that loan was taken out from the bank that they were ever going to use that for the purposes of trading the business. It was only as a use of basically getting money out of the company and then running away. That also only applies to companies. General misfeasance applies to companies only, to the directors of those companies. And there's four main areas, as you can see there, they tend to focus on. Retention of crown monies, i.e. paying all your other suppliers and not paying the tax man. Failing to maintain adequate books and records. So you should be in a position that you know the position of the company if you're a director. Payments of dividends. Commonly, directors pay themselves a nominal salary and then dividends, because that's the most tax efficient way of paying themselves. But those dividends need to be paid from reserves, and you cannot then declare those dividends and then subsequently go back later and say, actually, no, that was just my salary, and I'll pay the PAYE and national insurance on that. Case law has held that you can't do that. It's a loan and it's repayable if that's the case. And the last one is excessive remuneration. The directors effectively paying themselves a handsome salary, and the company simply doesn't trade well enough to justify that salary. The last section is excessive pension contributions. This relates to individuals that have been declared bankrupt. And if you are declared bankrupt, as long as your pension is in an approved scheme, which most pensions are, that pension is exempt from bankruptcy. The trustee cannot claim the pension for the benefit of creditors and can't force the bankrupt to draw down on that pension and introduce the monies into the estate. So what clever bankrupts, or people that were about to declare themselves bankrupt, realised was if they put a load of money in the pension scheme, then it couldn't be touched. So this piece of legislation was brought in, and where contributions are excessive, then those can be overturned by a trustee in bankruptcy. Let's talk a little bit about 2020. One of the government's responses to the pandemic was to introduce the Corporate Insolvency and Governance Act 2020. That's had a few things in there, more than is listed there, but the relevant ones to this presentation. The first is the suspension of wrongful trading. So there is a presumption for beginning of March and end of September 2020 that wrongful trading won't apply. That can be disproved, but it's basically trying to give directors a little bit of comfort that they can carry on trading, and hoping that things will improve once the financial outlook improves next year. Suspension on winding up petitions. No creditors can present winding up petitions at the moment. That's had a massive impact on the insolvency statistics this year, partly because HMRC are no longer chasing companies or individuals for debt, and it is potentially lulling businesses out there into a false sense of security. 2020 also introduced a new insolvency procedure known as a moratorium. This is a procedure where it enables a company to basically get some breathing space to enable it to restructure its debts. It has only been used maybe 2 or 3 times in the last 5 months since it became law. It does require directors to take advice at an early enough stage, something which has been historically a major problem. There's also been a ban on landlord evictions, which is potentially storing up a problem for next year. Rent hasn't been paid, but is still going to be due at some point. And when landlords are able to evict tenants, how active are they going to be? As I've spoken about briefly, HMRC, there's been deferrals of taxes due until next year. Is this just creating a problem for next year? People have been able to take out loans, sort of bounce back loans. Potentially this has led to a false sense of security out there, where individuals have believed that they've attained this loan and it's been able them to pay all the creditors, but then actually are they able to pay this loan when those payments become due in the next few months? And also individuals have been able to take payment holidays on their debts, sort of mortgage payment holidays. That situation isn't going to be able to go on forever, and the interest is carried on accruing. So again, potentially a problem for next year as well. Now, the answer to Paul's questions, I was talking to him before we went live. What should I do if my business is struggling? The answer is take advice, and do that as early as possible. The earlier you take advice, the more options there are available to you. The more likely one of those options is going to be a recovery procedure rather than a terminal liquidation or bankruptcy procedure. You're more likely to be able to obtain support from creditors, because if your plan is to propose a restructure to them, you're going to need their support to enable that to happen. But if you've buried your head in the sand for 6 months and completely ignored them, then why are they suddenly going to think, this guy's, the leopards have changed spots, and why should I support that business going forward? As I said, this has been a historic problem for the insolvency industry. People do not take advice as early as possible, as early as they should do. I understand that it's obviously a very stressful time. There might be an attitude of people not wanting to admit defeat, not wanting to face up to the problem. But I can say that doing that as early as possible, as I say, does give you a higher chance of that being a successful recovery. Our initial consultations, and 99.99% of insolvency practitioners' initial consultations are always free of charge. They're always confidential, impartial, and there is no obligation to do anything. We would like to see you and be able to say, no, actually, you've come to see us as early as possible. If you take these self-help steps, you'll be fine, and you won't need our services. That would obviously be fantastic news for everybody. I think that was my last slide. Yeah, it was. So that's yeah.
Okay, thanks, Jamie. Very comprehensive advice there. Let me just remove that so there's just the two of us. So I guess in essence what you're saying is, if you're finding it difficult as a business owner right now for whatever reason, don't bury your head in your sand. Go out there, come to somebody like you, who's going to give them a free initial consultation and at least let them know what the options are. And as you said, the earlier they come to, I guess that gives you more options, does it, in terms of what you can do?
It does. It gives us more tools in our toolkit, effectively. It also means that you're less likely to have wandered into one of those elephant traps. And at our initial consultations, we will always explain those antecedent transactions to an individual, not to scare them, but to simply say, look, this is the law. As it's, ignorance of that law is no defense. if you've committed one of these transactions, it will be pursued, and you need to know about that as early as possible. And if you are able to take that advice, as you say, as early as possible, then it can stop you from entering into one of those traps, and which could save you a lot of money going forward and a lot of stress. It also means you're more likely to be able to survive, and you won't have, annoyed everybody, all your creditors, and they'll be likely to support you, because certainly now, creditors are going to understand that your business has struggled for whatever reason, because it's not been a day since February where coronavirus hasn't been one of the top 2 headlines, is it? So
sure. So if people are still feeling a little bit nervous and anxious to come into an organization like you, is there anywhere they can go online, or is there anywhere else that they can sort of like turn to get some support?
There are charities out, certainly for individuals that are struggling with say credit card debt. There are lots of charities out there that will help you through the process. There is lots of advice available online. There's advice available on our website, for example. It can be quite technical sometimes, and it can often need an explanation by a human being. And the initial consultation doesn't have to be coming to our office and sitting in a in a face-to-face meeting and feel like you're sort of being told off by the headmaster. It could be a telephone conversation, and you'll feel much more comfortable because you'll be in your own home, and you don't even have to see us face to face if you don't want to. I mean, obviously this year we've done consultations via online portals such as Zoom, which work equally as well, and you get the comfort of being in your own home as well.
Okay, I've got a question from LinkedIn, Russell, who you know.
Yeah.
Can you see that question?
Yeah. Will creditors feel quite so lenient in 2021? I'm torn. Some of them will think, well, yes, because do you know what, we've been struggling and we understand the reasons why you've been struggling. But part of what they might think is we need every single penny we can get. So we would try and actually maybe ignore your proposal for a restructuring and try and turn up maybe and try and get our debt paid in advance of everybody else's, and so we don't have to be in this procedure. It's going to be an interesting one next year. The other issue that will affect most suppliers is HMRC become a preferential creditor again. They were last preferential creditor back in 2003 for the majority of the debt that they're owed. Certainly all the VAT, all PAYE, all employees' national insurance contributions will be preferential. And what that means is that they get paid before everybody else.
Mm-hmm.
So in the vast majority of cases, that's going to mean that there might not be a return to other creditors, because as we talked about during the presentation, who was the first person that most businesses stop paying when they struggle? It's the tax man, and he's going to get paid back first in these insolvency procedures.
Yeah.
So, that is going to be an issue for most of the rest of trade creditors. How are they going to get paid? Are they going to get paid out of an insolvent scenario? Probably not. So are they going to have to be a bit more bullish and trying to get paid before the insolvent scenario happens?
Yeah. Thanks for that, Russell. So unless there's anything else, we're probably done here. What I would say is if anybody's listening to this on replay, if you've got any questions, then, just put them in the relevant comment box wherever you're viewing this, and we'll endeavor to get back to you. If you are a business that's finding it difficult right now, or a business, then, Jamie is a decent enough sort of chap. You know, really, I think the essence of you and your colleagues is to help out where you can. So, you know, even if it's just sort of like point people in the right direction before they make some mistakes. And as you said, you know, the initial conversation is free of charge. Oh, we do have another question. You find business operations are too costly? Not quite sure what that specifically refers to.
No, I'm not either. Did you want to drop me a message on LinkedIn, James, and we can always have a more in-depth conversation if you want to. The one thing I would say as well, Paul, about is we wouldn't just advise the business that's struggling in an insolvent situation. If you are owed money by someone that you believe is likely to become insolvent, then we will obviously talk to those people as well and actually say, well, look, this is your right if the insolvent scenario happens, but you might want to try XYZ before to maybe say you'd look to get paid beforehand.
Absolutely. So thanks for your time today, James. James? Who's James? Jamie. Appreciate you're a busy man. And I've tagged you in the various places that we are on social media. So if you want to like those posts or comment on those posts, if anybody does have any of the comments like James, then you can get back to them. So I think we'll end the broadcast there. Thank you very much, Jamie.
Cool. Thank you very much, Paul.